So this is the past 5 years of this company's trailing 12-month revenue. Now, what do we see from this company? It goes up and up and up and remarkably consistent. It's a company that you can just basically count on growing revenue time in and time out. It's unbelievable how solid this company is. Now, we're looking at 1000xstocks.com here. Look at not only the revenue trend this company's been on, but look at what is expected to happen for this company based upon analyst expectations here. What a banger. Like, if you look at this revenue chart, like, this is like the perfect stock. Like, this might be the most perfect stock in the history of mankind. Like, this is unbelievable. How many companies can you count on quarter in and quarter out, year in and year out, just growing at a solid clip? Additionally, look at the earnings per share. This is where we're at for this company's earnings per share. And this is what is expected to happen for this company's earnings per share over the next many quarters here. I just showed you all that. If that's all I gave you, how much do you think this stock would be up in the past 5 years? We know it consistently just grows and grows and grows. We know the earnings per share is expected to take off like a rocket ship here. We know it's just going to continue to grow for this company. I would say this stock's probably up anywhere from 50 to maybe 200% in the past 5 years. That would be my guess. 50% on the low end, kind of midpoint of 100%, probably doubled up over the past 5 years. Maybe it's up like 200% or so. Well, be prepared to have your mind blown. This stock is not up. It's down 12% in the past 5 years. And the company is named Adobe. ADBE on this one. Unbelievable to see that this stock, regardless of its great performance, is down 12%. Now you may say, well, maybe the company is getting majorly disrupted right now. Well, you know how we can see if that's actually happening or not? We can look at the latest numbers that this company just came out with not very long ago. Here's what happened with the company. The company on a GAAP basis had revenues go up 11% year over year. On a non-GAAP basis, revenues were up 13% year over year. Look at the earnings per share of this company. Non-GAAP EPS of $5.06. GAAP EPS of $3.94. Folks, let me ask you a question. Very important question. Does this look like a business model in decline to you? The answer should be, and it shouldn't take a rocket scientist to figure out this one, or a business genius, or somebody who's been in the market for 16, 17 years like myself. No, that does not look like a business in decline at all. Actually, it's a business in phenomenal financial position. Now, in regards to Adobe, you're going to understand they have 3 segments of customer that they attract very well. One is business professionals. They do a great job of attracting those folks. The second group of folks they attract to a lot of Adobe products are creatives. So think about people that do a lot of posting on Instagram, TikTok, YouTube, right? The whole influencer economy, all that stuff. High probability folks like that use at least one of Adobe's products, if not several. And the third group of customers that Adobe has are marketing professionals. If you're run any sort of marketing department for any large company, mid-sized company, or even small business, high probability you use Adobe. And so they have a phenomenal customer set, and they're just very ingrained with those folks, and they're doing phenomenal work when it comes to their AI products and everything like that. Now, here's the deal with Adobe. I showed you the revenue, I showed you the earnings per share and what's expected here, I showed you the latest numbers, but here's the deal. If you're truly a great company, you should be able to come in and beat analyst numbers quarter in and quarter out. Not many companies can actually do that though. Look at Adobe. 10 straight quarters of double beats. A double beat is when you beat on earnings per share and you beat on revenue. How many companies in the stock market have beat analyst expectations on a double beat 10 straight times? Not very many. That's legendary. If you could do that 10 straight quarters, legendary. And that's what Adobe has done here. So Adobe is a company you can trust coming in and beating revenue expectations and earnings per share expectations almost every single quarter. And I mean, heck, literally over the past 10 quarters, they've done it every single quarter. That's very comforting feeling. That means the management team knows what the company's going to do. It's not just like we're winging it. It's very consistent. This is like what you would expect from Microsoft, right? Microsoft's one of those companies, just solid. They should come in and beat numbers every single quarter. And that's what Adobe does. No, additionally, we looked at the revenue, so consistent for this company. Unbelievable, right? But additionally here, look at the gross margins of the company. The gross margins of the company are right around 90%. I mean, how many companies have gross margins, you know, let's call it high 80s to around 90%? Not very many companies. That's legendary. Additionally, look at the gross margins of this company. They're right around the 30% range, which is your top tier, one of the best companies in the world. If you can have your net margins being around 30%, legendary, okay? Now, this is a very important graph you're not going to see many people talk about, okay? What I'm showing you right now is operating income. Now, operating income is extremely important to always look at this for what a company's doing operating income wise. This is going to give you a good understanding of how much money is the company actually making, bringing in through the door, and actually being able to keep around, right, after operating expenses are taken out. And here's the deal. This company's operating income is ridiculous, and it continues to build, and it's going to continue to build over the next several quarters. Now, with this operating income, they can take this and do share buybacks, right, which is going to help your earnings per share over time. They can pay out dividends. They can buy out businesses, other companies with this, right? And so their operating income is incredible at this company and continues to build for the company overall. Now, let me show you my bull case, base case, and bear case for Adobe. And you're going to begin to understand why I love this stock so much right now, and why it's, in my opinion, like a steal deal buy right now, and why I was actively buying this stock today. I was buying Adobe stock today, and I plan to continue to buy this one for a while. My bull case for Adobe has them growing revenue 12% per year. Now, on a non-GAAP basis, they just grew actually 13%, but even my bull case is under that. So my bull case has them growing revenue 12% per year. I have them doing net income growth of 14% per year, so just a little eclipsing the revenue growth here. Net income margins of 37% come 2029. Now, if they're growing 12% top line, 14% bottom line, SaaS-related business, recurring revenue, a 30 to a 35 P is very fair for this company, which puts the stock price in 2029 between $952 and about $1,100 plus dollars. The stock today is in the $300 range. This would give me a compounded annual growth rate of 26% on the low end and 31% on the high end here for Adobe. But let me show you my base case. My base case is just a fancy way of saying that's just what I expect, okay? My bear case is like if things go better than I expect. My bear case, my bull case. My bull case is I expect things to go better than what I have here. And my bear case is like I expect things to go quite a bit worse than what I have. But this is what I personally expect to happen for Adobe. I think they're going to grow revenue 10% per year on average, 2026 to 2029. I think they're going to grow net income 12% per year on average, 2026 to 2029. I think their net income margins will get to 37%. And I think they'll be able to easily command a P ratio between 28 and 33, considering it's a low double-digit grower, right, and a consistent business model that grows year in and year out, right? That puts the stock somewhere between about $820 and right under $1,000 a share come 2029, which gives me a compounded annual growth rate on the low end of 22% and on the high end of 27%. Now that is special, because not only is it like a great money-making opportunity, but here's the deal. This is a situation where I'm not even taking a big risk in this stock. It's not like this is some crazy business model that's on shaky financial ground. This is like one of the best income statement, balance sheet, cash flow companies you're going to find in the world, and one of the most consistent business models you will find in the world. And it's extremely sticky, and it keeps people on the recurring plans. Like, it's a holy grail business model. So if I can get on my base case a 20% plus compounded annual growth rate, I'm going to take that every day of the week. And that's exactly what we have in regards to Adobe here, right? Now, let me show you my bear case. What if things go far worse than I anticipate? This is always important. You guys always have to, it's one thing to be like, oh, you know, I'm so bullish on the stock. I think it's going to do so well, blah, blah, blah. You need to run a bear case before you make any investment in any stock, ladies and gentlemen. There's a reason on 1000X I have it so you can do your bull case, your base case, and your bear case all together. Because if you're not running a bear case, then you're not taking into account the risk. So what happens if this company grows way less than I anticipate, right? I had that scenario. So in my bear case for Adobe, the company only grows revenue 6% per year. This would be disastrous. Remember, on a non-GAAP basis, they just grew in this last quarter 13%. So we're talking over 50% decline in growth rate, right? This would be horrible for the company. 6% revenue growth on average, 2026 to 2029. Net income growth of only 8% per year, 2026 to 2029. That would not be good. Now, if they're only growing 6% top line, 8% bottom line on a SaaS related company, you're going to probably put a 20 to 25 P ratio on the stock, which puts the stock $511 to $639, which gives me a compounded annual growth rate, ladies and gentlemen, of 8% to 14% under a bear case. Under a bear case. Now, we could take these numbers down even further. We could say only grows revenue 4%, only grows net income 6%. We could make it like insane super bearish case, right? And even in that case, I still wouldn't actually lose money in the stock. The only way I could lose money really in Adobe holding the stock over the next 4 or 5 years is in a scenario where their revenues literally decline, like they start literally going down, like revenues shrink. And is that at all realistic for this company? It's very unrealistic. All things are possible, but that I would put at like a 2% probability of like, what are the chances Adobe's revenues go negative over the next 4 or 5 years? Literally, I'd put that at like a 2% probability. That would be insane. So the moral of the story is here in regards to Adobe is this stock is a screaming buy. When I can run a bull case, bear case, and a base case, and all of them I make good money, and when my base case has me getting a compounding annual growth rate of 20+%, I'm going to take that bet every single time, right? And especially when it's this consistent, a business model this good. And let's also not forget, you're buying a company that has a CEO, right? And the CEO, he's done a phenomenal job leading this company. He's been leading the company for, easily 15 plus years now at this point in time, if not pushing closer to 20 years. And he's done a great job running this company and getting them through all these different time periods and keeping the company relevant in all the different technology changes, right? And taking Adobe into a subscription business model over the years. Like, he's done a phenomenal job pivoting, understanding. They got an amazing employee force over there at Adobe that continues to innovate. So, the moral of the story is here in regards to Adobe is they look good. And also keep in mind, they are one of the beneficiaries of AI from a perspective of bringing in new people to use their new AI products, but also from likely the development standpoint. They're going to probably be able to save a lot of money over the next 5 or 10 years in regards to software engineers, because now a lot of AI is being able to write code. Their software business model, right? So do keep that in mind. And that's why you should expect net income margins to increase over the coming years. So gross margins could stay flattish, somewhere around here roughly, but net income margins could continue to go up quite dramatically over this next 5 to 10 years. While revenue increases, while earnings per share increases. It's good, man. I like this one a lot, okay? Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in, or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. Let's go ahead and react to Tom Lee.
Certain head of research. He's here with us at post 9. In the market, good to see you, by the way.
Cheers. Great to see you.
The market clearly doesn't think that tariff turmoil is going to hit the economy and stocks. Is that the right way to think about it?
Well, I think the economy, we've had enough data to know that the tariffs aren't necessarily hurting the consumer wallet or hurting jobs growth yet, but we're just waiting for, as Fed Chair Powell says, to see how it shows up in inflation. So I think the next 2 inflation reports are going to be closely watched, because if we don't see a meaningful pickup in core inflation and consumer inflation expectations don't move up, then it's going to give the Fed a lot more comfort about cutting over the next 12 months, and that would be good for stocks.
The president continues to talk tough as it relates to tariffs and his trade war. The market, I think, is continuing to reflect a I don't necessarily believe you mentality, that the tariffs are, in fact, going to end up on August 1st, as bad as they sound today or may sound in the days leading up to August 1st. Is that how you think the market is taking it right now?
Well, I think the market's somewhat pragmatic, and they realize the president is making statements to try to force negotiations to come to a close. But at the same time, the president is practical and knows that he doesn't want to upend the economy. So I think the market is trying to manage that balance. And yesterday was a day where they weren't so sure. That's why I think we had a lot of selling. But I think, as time passes, I do think at the end of the day, we expect the White House to find something that is a good balance between the two.
All right. So you're going on the idea, it sounds like, that you think tariffs aren't going to be as bad as the bark would suggest. Is that at the end of the day? Is that right?
That's right. I mean, tariffs are already annualizing $2.4 trillion a year, which, if you now compare it to where the budget is, it's actually neutralizing, the current budget. But it hasn't hurt the wallet and consumer confidence, and it hasn't hurt S&P earnings. So I think at the end of the day that we've had enough time pass that investors can sort of breathe a little bit of a sigh of relief and realize the tariffs, they're important to the White House agenda, but they're not going to necessarily derail the economy.
What if there's too much complacency around that? Got a VIX at 16. You said it's too soon to tell. That's why Chair Powell is waiting to see what happens with inflation. What if we just don't know yet what the real impact on the real economy is going to be?
That's true. That would be a negative fork if that were to happen, and I think the VIX would go up.
Well, isn't that a real possibility? Actually, it's a certainty. Today, we don't know. Do we?
Well, and Scott, if we went down that path, then it would also open the door for the legal challenges to come back about what kind of tariffs can be levied without an appropriate process.
Sure.
So I think at the end of the day, look, investors should keep that in mind, but then they should realize we had a black swan develop in April.
April 2nd.
April 2nd, a waterfall decline in stocks. The VIX went to 60, and everyone thought the market wouldn't recover because the Fed wasn't going to unleash liquidity, but it was a V-shaped rebound. So,
and listen, when is it 100% of the time, a guaranteed time, that's a great time to buy stocks? I'll tell you when the VIX goes over 50. It's never been proven wrong. In the history of the VIX, every single time it goes 50 plus, you buy stocks, and a lot of times within a few months or within a year or so, you've already made fortunes of money. Fortunes of money. If you see that VIX go 50 plus, man, you got to be buying everything in sight. And then when you look back 3 years later, 5 years later, you're like, thank goodness I did that. I know that was scary. I know it was drama time. But that VIX goes 50 plus. That is the biggest buy signal you can ever get in the stock market.
if that should be in people's back of their mind, they shouldn't be too bothered, even if we get a bad chapter in this tariff story.
What's priced in at this point? I keep hearing from people, well, a lot of the good news now, given the rally back and the V-shaped recovery that you said, now all of this good news is priced in. Is it?
I'd say that the ones who are saying it's priced in are a lot of the folks that missed the rally. We speak to a lot of high net worth and hedge funds. Many have missed the bulk of that rally, and they are very skeptical here.
They're mad and they're hating on it now?
Yes, that's why it is the most hated V-shaped rally ever.
True.
I mean, worse than 2020 and 2022.
True.
But I'd argue that the PEs should be expanding. The median PE, the S&P, is lower than it was on the eve of COVID 2020 by 1.5 turns. Mm-hmm. So the market's cheaper, and we had 6 black swans. We had COVID, we had the supply chain shock, we had the inflation shock, the Fed's fastest hikes in history, we had Trump Armageddon, and then we had the U.S. bombing Iran nuclear facilities. 6 black swans. Mm-hmm. The market produced earnings growth the entire time. If this was a stock, we would say it's sort of indestructible and we should give it a higher PE, but the market derated.
All right, I'm writing down as you were.
Fair play. And it goes back to a chart I show every once in a while in the private stock group. I'll post this chart that shows over the past 20 years or even over the past 50 years, all the stuff that has happened, or you can even take it over the last 100 years, all the things that have happened, all the drama, geopolitical related things and wars and inflation and this and that and this and that, right? And at the end of the day, stock market goes higher. Like, it all is short-term drama, cause the market to go down short-term, but at the end of the day, stock market just goes higher.
You were answering that question. Can the multiple expand while earnings and margins are contracting? Can that happen? Because margins are probably contracting a bit, right? I mean, unless you're passing through all these costs to your customers, which I think a lot of companies are reticent to do. Earnings, we know, are contracting because estimates have come down by near half.
Yeah. Now, on the margin side, you have to keep in mind that if, let's say, companies are eating half the tariffs, the gasoline already offsets that. So I'd actually say there's no margin risk from the current level of tariffs.
No margin risk at all from now?
Yeah, I mean, on balance, because there's 500 companies, but I would say it's offsettable because of the way some of the commodities have deflated. So I think earnings growth is actually still intact.
But sure, we are going to have earnings growth.
Yeah.
Growth is intact at far slower levels than we were once thinking.
However, we also know that ISM has been below 50 for 29 months, a record period below 50. And that is highly correlated with S&P forward growth. So if we get the tariffs issue settled and the Fed breathes a sigh of relief, starts cutting, and the ISM moves above 50, I think earnings estimates for next year actually go up.
So you think the Fed coming in and cutting is because they can, not because they have to?
That's right. I think the easiest way for the viewers to understand is Europe uses a thing called HICP as their core inflation.
Hold on, before we go further here. Do I see a situation where I could see earnings being revised higher in terms of earnings expectations? The answer is yes, I could see that. Let's see what type of dynamic we have. We have unemployment stay in the 4s. If we have that, along with wages continue to outpace inflation, like all this tariff talk about, it's going to cause inflation to go crazy. Let's say it never comes to fruition, right? And so wages continue to outpace overall inflation in terms of goods inflation, everything like that, right? And the wages matter much more to people because at the end of the day, like, everybody makes more than they spend unless they have some sort of insane spending problem, right? Which is a whole different situation. But most people, they make more money than what they spend. And so when you understand that, like if wages go up, let's say 3.5%, but let's say everything that a person has to buy only goes up 2.5%, you're winning. That means you have more money in your pocket, more money to spend, on stocks, more money to spend on real estate, more money to spend on vacations, more money to spend at the restaurants, more money to spend at the mall, blah, 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 right? More money to spend on Amazon, right? All that good stuff. And so if you have that sort of dynamic, at the end of the day, like, could I see earnings expectations being revised higher? Yes. And also remember, 2026 will be the year that we start to see the Trump economy. And if the Trump economy is supposed to be everything it's cracked up to be, right? This great growth economy, we'll see GDP, go considerably higher and spending go considerably higher. So, this all remains to be seen. But if that all plays out, I wouldn't be surprised at all if earnings are revised a lot higher in terms of expectations.
Organized inflation, which excludes shelter, it's running at 1.9%, and they have a 2.5% ECB rate. If you use
this, cut like 10 times.
Correct. And if you use the U.S. measurement the same way, excludes shelter, because Europe's core inflation excludes shelter, U.S. core inflation is 1.9, and the Fed's at 4.5, 200 basis points higher than the ECB using the exact same inflation basket.
So you think that the Fed should already be cutting?
Yes. I would say that on that measurement, because I'm not the Fed and I don't do policy, but by that measurement, they should be.
You can't fall back on that if you just lay out your whole formula as to why they should, that rate should be markedly lower than where they are now.
Okay, then maybe I'd say if I looked at where the 2-year was, like which Jeff Gunlock cites, the Fed is 3 or 4 cuts behind, yes.
Well, how many do you think we're going to get this year?
Well, I think the market's pricing in 2.6. So let's say 2 is likely, but that still doesn't seem like enough cutting given where inflation is tracking.
So if we're 6,200.
I agree with that. That's not enough cutting for what the Fed should be doing. But with that being said, 2 cuts is likely. Like they're likely going to do a September cut and they're likely going to do a December cut. But I agree, like they should be cutting more than that. especially if they're only going to do 25 basis points. Now, if they did 250s, then we could be a little different. But the Fed doesn't like to start a cut cycle with 50. I think they want to start 25 and then probably follow up with a 25 and then get us to 26 and then try to figure out, do we want to continue with 25s or do we want to amp it up to 50s at that point in time, right?
Call it today on the S&P. What's likely for the end of the year, do you think? What's reasonable? Not likely. You don't need to make an exact number call for me. But what sounds reasonable to you?
Well, so I would advance the argument that the PE should be going up because we had 6 black swans and the market has proven the resilience.
Going up to what? We're like, what are we, 22 times now, aren't we?
21 and a half.
Sorry, I overestimated by a half.
Yeah, but the median is only 16.8.
But that speaks a lot to what got us here in the first place. You've had this massive, large stock rally, right?
Yep.
So
so I might say.
So this is why I really like this interview a lot here with Tom Lee, because there's a lot of like pushback, like, oh, here you go, this and that, this and that.
Why not the other 493 get a 2 turns multiple increase, and you'd be 6,800-ish.
Can you do that if there are questions about the resilience of the economy at this point?
I think so, because financials, industrials are interest rate sensitive, so I think they would actually reflate on the idea the Fed would be cutting. And there's a lot of tech that actually still has reasonable multiples, and of course we know the cyclicals and the semis would still rise. So yes, I think a lot could rally.
One of the knocks on the rally itself is that many stocks, as we're talking, it plays right into that story, outside of the S&P 500 are not hitting new highs. This record-setting rally would have you believe that everything is going up, when in fact it really hasn't, and certainly not at the same pace, and not even close.
Yes, well, people always find quibbles with new highs, but we also know that for an institutional asset manager, it is not really excusable to be bearish when the market makes a new all-time high. So in other words, the institutions now have to start adding risk to, if we're making all-time high, because it's a new bull market.
Oh, okay, so we're...
Ooh, that's a big point. Big point there, right? Institutions, big money has to start adding more risk, not less risk, now that you hit new all-time highs, right? Additionally, you got to keep this in mind. What happens when the stock market hits new all-time highs? What usually happens is the stock market hits new all-time highs, followed by new all-time highs, followed by new all-time highs, and then eventually that trend breaks. But usually you get many months, sometimes many years, of all-time highs and all-time highs and all-time highs before you actually get a considerable, many month or many, let's call it 6 month, before you get a 6 month to 18-month downtrend in the market. You can go through months, many months, or sometimes many years of all-time high, all-time high, all-time high, all-time high. So do keep that in mind. At the least, you usually get several months. So assuming, we just hit all-time highs very recently, so you could push that all the way out to September into October of hitting new all-time highs after new all-time highs. Then we can see what happens after that. But you could push for several years to new all-time highs.